In 2024, responsible investing accounted for $6.5 trillion in the United States alone. That capital represents exactly 1 in every $8 under professional management, placing sustainable investing at the center of global finance. But take a look at this chart tracking capital flows for North American sustainable funds. Beginning in the fourth quarter of 2022, the line drops off a cliff. We see 11 consecutive quarters of capital outflows as investors pulled their money back. To understand why investor trust eroded so quickly, you have to look at the underlying assets. An independent forensic audit found that out of 14,291 supposedly sustainable European funds, 4,792 are invested in companies expanding fossil fuels. Embedded within the broader European ESG market is 123 billion euros of fossil fuel investment. Zooming in on that chunk, a 38 billion euro sliver is parked in funds marketed as environment, sustainable, and impact. When a retail investor buys an impact fund, they expect that money to build clean infrastructure or advanced materials. Finding out their investment maintains the liquidity of legacy oil and gas producers breaks the core promise of the product. Globally, the numbers are even larger. Major asset managers currently hold $376 billion in oil and gas companies, even while publicly pledging to align their portfolios with the 1.5 degrees Celsius limits set by the Paris Agreement. Digging deeper, a specialized subset of 160 explicitly green-labeled funds holds $4.6 billion directly in primary producers like ExxonMobil and Chevron. In 2022, 25 members of the Net Zero Asset Managers Initiative increased their equity positions in these fossil fuel entities. This bar chart maps the institutional architects of this exposure. BlackRock maintains 6.4 billion euros of fossil fuel exposure across 111 green funds. Crédit Agricole holds 3.6 billion euros, and UBS manages 2.8 billion euros embedded in specific sustainable funds. The world's largest asset managers engineered fossil fuel inclusion as a structural feature of these portfolios. The ability to slip an oil major into a green fund comes down to the math of modern rating methodologies. Data providers like Sustainalytics apply a metric called an issue manageable risk factor. This assumes up to 100% of a company's severe environmental risk can be managed away by strong corporate governance. This diagram shows how that logic works in a financial model. A company categorized as having severe risk might see its cost of capital adjusted by just 50 basis points. That penalty calculates out to a 0.4% drop in the net present value of the company's forecasted cash flow. Because the mathematical penalty is so small, the heavy polluter clears the threshold and remains eligible for inclusion in an ESG portfolio. When indexes do use explicit negative screening, they rely on permissive revenue loopholes. For example, some MSCI indexes allow a company to be included as long as it derives less than 5% of its aggregate revenue from conventional oil, gas, or thermal coal mining. For a multinational conglomerate generating $100 billion in total revenue, that 5% threshold permits up to $4.99 billion in direct thermal coal mining or extraction revenue without triggering an exclusion. Other baseline indices apply even wider margins, allowing utility companies to generate up to 50% of their revenue from electricity generated by thermal coal or natural gas. By relying on revenue percentages instead of absolute emissions, these thresholds create a mathematical illusion of purity. They protect the capitalization of the status quo while doing nothing to reduce carbon in the atmosphere. Asset managers justify these holdings as transition assets, arguing fossil fuel companies need capital to finance their pivot to renewables. Yet in the 2022 fiscal year, the asset manager DWS deployed approximately $850 million from its purportedly green funds directly into fossil fuel companies. This bar comparison exposes the reality of capital deployment. While DWS poured $850 million into expanding fossil fuels, its equity investments in actual renewable power companies hovered at just under $200 million. To justify anchoring these funds, these companies usually only need to maintain a baseline MSCI ESG rating of BB and a controversy score of 2, a hurdle easily cleared by any global corporation with a dedicated compliance reporting department. This misalignment eventually triggered dual enforcement actions in Europe and the US. In Germany, prosecutors raided DWS and officially found the firm guilty of greenwashing, levying a €25 million fine. Concurrently, the United States Securities and Exchange Commission imposed its own $25 million penalty on DWS to settle overlapping charges regarding ESG misstatements and failures in anti-money laundering policies. The SEC also scrutinized internal operations, finalizing a $4 million penalty against Goldman Sachs Asset Management for failing to follow its own written ESG evaluation policies between April 2017 and February 2020. These aggressive raids signaled that regulators now prosecute greenwashing as financial fraud and a breach of fiduciary duty. In response, global regulations have fractured. By May 2025, the European Securities and Markets Authority enforces a strict ultimatum. Any fund using terms like impact or sustainable must legally align with Paris-aligned benchmarks. Asset managers must either divest their heavy emitters or rename their funds. However, €17.1 billion in fossil investments remain entirely exempt from these rules because those specific funds use generic branding. Meanwhile, the United Kingdom has taken a more pragmatic approach. As of early 2025, 43 funds have voluntarily adopted the Financial Conduct Authority's new Sustainability Disclosure Requirements labeling system. On March 27, 2025, the SEC abandoned its defense of climate disclosure rules following a change in political administration. That retreat was the direct result of a highly organized political countermobilization. During a single legislative cycle, 106 anti-ESG bills were introduced across 32 states, with 9 signed into law. Many of these interventions take the shape of debanking laws. States are now prohibiting large financial institutions from canceling corporate accounts based on internal ESG screening mandates. State corporate law is also targeting the mechanics of shareholder activism. Texas Senate Bill 1057 requires an investor to hold 3% of a company's total voting shares, or $1 million in market value, continuously for 6 months, just to submit a preliminary proposal. Even if they meet that threshold, the submitting shareholders must independently solicit holders representing 67% of total voting power to actually advance a climate resolution. The operational intent behind this web of legislation is to weaponize the mechanics of state law to legally shield legacy fossil fuel infrastructure from institutional climate accountability. Between the strict mandates in Europe and the legal hostility in the United States, the market for these labels shrank. In 2024, 71 existing ESG funds closed their operations. Looking at this line graph, we can trace the shift in market sentiment. Fund launches fell from 116 new U.S. funds in 2022 down to a mere 10 launches in 2023. This legal risk triggered greenhushing, corporations scaling back public claims to avoid litigation. But beneath the silence, operations expanded. A 2025 survey revealed 83% of executives increased hard capital sustainability investments, even as public ESG mentions disappeared. The retreat from generic ESG labels marks a shift from performative marketing toward disciplined enterprise risk management. If these funds are to survive, they must move away from relativistic scores and replace them with absolute carbon accountability.